Welcome to the Fintech One-on-One podcast. This is Peter Renton, chairman and co-founder of Fintech Nexus. I've been doing this show since 2013, which makes this the longest-running one-on-one interview show in all of fintech. Thank you for joining me on this journey. If you like this podcast, you should check out our sister shows, the Fintech Blueprint with Lex Sokolin and Fintech Coffee Break with Isabel Castro, or listen to everything we produce by subscribing to the Fintech Nexus podcast channel. Before we get started, I want to remind you that Fintech Nexus is now a digital media company. We have sold our events business and are 100% focused on being the leading digital media company for fintech. What does this mean for you? You can now engage with one of the largest fintech communities, over 200,000 people, through a variety of digital products, webinars, in-depth white papers, podcasts, email blasts, advertising, and much more. We can create a custom program designed just for you. If you want to reach a senior fintech audience, then please contact sales@fintechnexus.com today. Today on the show, I'm delighted to welcome Laura Kornhauser. She is the CEO and co-founder of Stratyfy. Now, Stratyfy is a super interesting company. They're focused on AI-based risk decisions for lenders. We actually obviously talk about what that all means. We spend also a lot of time talking about bias and how Stratyfy's models really help identify bias. We talk about transparency and how that is built into everything that they do at Stratyfy. We talk about the different types of data. We talk about how their models have improved, what's involved in implementing Stratyfy into a new lender. We also talk about just AI in general and why it's been such a hot topic and how that's impacted them. We talk about funding rounds and much more. It was a fascinating discussion. Hope you enjoy the show. Welcome to the podcast, Laura.
Thank you so much, Peter. Happy to be here.
All right. Great to have you. So let's kick it off by giving the listeners a little bit of background about yourself. I know you had a decent stint at JP Chase, it seems like. Tell us some of the highlights of your career to date before Stratyfy.
Wonderful. So yes, I started my career at JP Chase. I spent over a decade there in both lending and risk roles in the institution, which is where I uncovered many of the problems or saw firsthand many of the problems that we address here at Stratyfy. Prior to that, I am an engineering undergrad, studied machine learning in my undergrad degree before it was called that. It was just called advanced statistics back then. And then, when I was transitioning out of JP Morgan, when I decided to leave, I very much had the hopes and dreams of starting a company. My parents are entrepreneurs. They started a business around the time I was born and then built and grew it into a multinational business that they eventually sold to a strategic. So those were my true, first jobs, starting from, answering the phones when I was in high school all the way up to network editing when I was in college. So,
Wow.
I always had that entrepreneurial, if you will, spirit within me. Went the completely other direction, as many, I would say, third children often do. Out of undergrad, but then very much knew I wanted to return to that home and be a founder.
Okay, so let's talk about the founding story then, Stratyfy. What specifically did you see and what are you trying to solve?
Absolutely. So interestingly, after leaving JP Morgan, I had a personal experience where a credit card product was heavily marketed to me actually by Chase, of all people. And it had a great points plan, and I'm a sucker for a good points plan. And I signed up for the credit card and I was rejected. And that then led me to, call the number on the back of my rejection notice, talk to someone that I provided some additional information to, and then literally you can almost hear the boop, 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 boop in the background. And I was actually approved over the phone. And that experience for me really opened my eyes to the way in which credit decisions are made by so many institutions and the large groups of people that are left out from those decisions. I was in a fortunate place. I didn't need that credit card. It was not something that was going to materially change my life. But for many other folks, these types of credit products are help them buy their first home, help them fund inventory for their small business, and have really meaningful impact. And that was something I really wanted to address. I was fortunate around the same time to meet my co-founder, Dmitry Lesnick, and he had been spending the prior decade before us meeting developing a family of algorithms that's still at the core of the technology and services we provide at Stratyfy. And what's really nice about that family of algorithms is it enables you to learn from data automatically, scalably, but in a way that is highly, highly transparent to the user. So I saw the application within credit and within other highly regulated use cases where, I, in my previous life at JP Morgan, had even struggled to get the right technology to fit the problems that we were trying to solve.
Okay, so then fast forward to today, you founded it was it 2017,
Yeah. Mm-hmm.
6 years ago now. Tell us a little bit about how the company's evolved and how you describe the company today.
Yeah. So when describing the company, I start with our mission, which has been our mission since the get-go, which is to enable greater financial inclusion for people while also helping financial institutions better manage and mitigate risks. We see it as two sides to the same coin. We can't do the first without doing the second, or we can't do the first scalably without also doing the second. So when we started the company, we were very focused on credit risk scoring and credit risk decisioning. So helping lenders understand the true risk of borrowers, primarily consumer and small business borrowers, helping them understand that true risk and make more informed decisions based on those enhanced risk predictions that, yes, leveraged insights from data in an automatic way, but did so in a way that still allowed a non-data science user to understand what the heck was going on, which we continue to see is really important. Fast forward to today, there has been a ton of focus in the industry, not just on AI and machine learning over the last, in particular, year or so, but a tremendous focus on the industry about how technology can be leveraged, but in a safe and sound and fair way. And we are perfectly positioned for that. I would argue that maybe when we started the company, we were still a little bit early for the market, but the growth trajectory that we've seen, particularly over the last 18 months, has really been unbelievable and also allowed us to expand into other use cases. So right now, we also have customers in fraud detection, where we're helping them identify fraud, ensuring fairness, and reducing false positives along the way. And then we also pulled out our bias detection and mitigation capabilities into a separate solution that we call UnBias, that focuses squarely on fair lending risk assessment and enables lenders to do that more efficiently, more proactively, and identify risks before they become problems.
I wanted to sort of get a sense of who you're working with. What are some of the financial institutions? What types of financial institutions do you work with right now?
Yeah. So we started off working primarily with fintechs. So those were our early adopters, our initial customers, and enabled us to get some really unbelievable product feedback and quick iteration cycles on our offerings. Now we're working with banks, and we're working with banks actually from a pretty wide spectrum right now. Our largest banking customer is a top 10 bank in the US. And then we're also working with smaller community banks and a number of CDFIs, most notably through a recent initiative we launched called Underwriting for Racial Justice, and the pilot program that we're the technology partner for that we can definitely talk more about. But we see a huge opportunity in the CDFI space in particular, and we see a huge opportunity in community banks for technology like ours. And then we're also seeing quite a demand from the, I would say, big community banks transitioning into regional banks as well.
Okay, so then you're not in this space alone. There are others that are also providing services to those kinds of financial institutions. How are you different from others in the space?
Yeah, so where we really differentiate ourselves is in the level of transparency that we provide into both models or scoring systems and decisioning systems. So that has become a little bit of an overused buzzword where everybody claims to have transparency. When we say that, we mean that our users have full visibility into the inner workings of how a model or a strategy works. They also have the power to make changes. and do so, without writing a single line of code. We find that that ends up being really meaningful, especially for, again, the community banks out there, and even many of the regional players that, if they have a data science team, it may be a few people. If that, they're really stretched, overworked. And what we really are focused on doing is how do we bring the tools of data science to the subject matter expert, to the user that really understands credit and sure is very highly competent in data and knows data, but is not a data scientist, is not a engineer. How do we give them tools that they can really feel comfortable using because of the level of visibility and control that we provide versus others? So no black boxes whatsoever with Stratyfy, and all that is enabled by that core technology that I mentioned earlier.
Interesting. I want to touch on bias. You mentioned it a couple of times already here. It sounds like this was a really founding principle for you guys. What is your approach? Maybe you can explain exactly, how your models are able to identify bias better than others.
Yeah, so this is you're absolutely right. Part of our founding approach, our initial solution that we built, our credit risk assessment and decisioning solution, always included bias as a KPI of models. So we always thought that was one of the performance indicators that you should be looking at when evaluating different strategies, different options, different models. And, what we do is we are not in the business of saying or determining what is fair or what is not fair. What we are in the business of doing is offering a number of different tests, metrics, all of which can be easily leveraged within our tools to evaluate the potential bias that could creep into addition. So one thing we do, Peter, is we support a number of different bias metrics and let our user make the decision about what metrics matter most to them, what metrics matter most to their regulators, their customers, and they can select those. And then the way our UnBias product works is the first step, we actually break it into 3 steps: uncover, understand, undo. So the first step, uncover, is all about running those tests, running them in a very robust yet automated fashion, such that a lender can run those tests more frequently and more proactively. If a risk emerges according to one of those indicators, we move to step 2, or allow the user to move to step 2 within our products, which is understand. There we decompose that risk. So what are the primary drivers? What are causing that bias risk to emerge? And then after illuminating that, we are giving our customer the information they need to determine if they need to take action. And if they decide they want to take action, we also, with the undo component, can help them figure out the way to remediate, make changes to their models, and correct for or compensate for the bias that has emerged. Because nobody sets out to build a bias model or a bias decisioning strategy, right? There's not a lender out there that says, hey, either my humans making decisions nor my automated system, or some combination of both, as is the case at many lenders, right? Nobody intends to have that bias. But we find that a lot of the robust checking that happens kind of on launch, before a new strategy is launched. And then, yes, there are periodic check-ins as well, but oftentimes things can kind of get off the rails faster than the next periodic check that comes in place. So, our goal with this product offering, what we've been able to deliver to customers, is better visibility into an ongoing monitoring of those risks, such that you can address an issue before it becomes a big problem.
So you might see, like, someone's running your models and there's been, say, several weeks go by, and they can start to see, there seems to be, like, whether it's, women, whether it's racial, you can say, right, it seems to me that you're declining more of these types of people than you should be. And so, I mean, is this something that is there a trigger point, or does the customer set the trigger point?
Customer gets to determine the frequency with which they want to run the evaluation. We can do it daily, or even multiple times a day should a customer want. Though we find that in most cases we're looking at monthly or quarterly that folks want to do these checks. It's very hard to measure if you don't have a sample set that is a big enough size. You can run into situations where you may flag something that is not statistically significant. So we're really focused on not just the measurement, but ensuring that that measurement is statistically significant so that we can feel comfortable quantifying something as a risk and we're not, throwing up a bunch of flags where they don't need to be.
Right. I imagine that could be a challenge for some of the smaller community banks, right, that don't have that volume.
Exactly. Don't have the volume to, run with any more frequency, than monthly, if that. And often for the smaller banks, they want to run that on a quarterly basis. But, our technology enables them to run with whatever frequency they want, but we find the market wants monthly or quarterly.
Does your system also kind of help with the adverse action letters or someone's been declined, and obviously we need, people need to know why. Is that part of what you're offering there?
Absolutely. And it's also something I see as a differentiator of ours, again, pointing back to the level of transparency of our underlying approach. A lot of folks that use other machine learning approaches and then provide adverse action notices off the back are using things like Shapley values to provide those adverse action notices, or the reason codes. Regulators have come out and raised flags about those types of post-hoc explainers. Now, they haven't said they're not explainable enough. I think the exact language that was the post-hoc explainers may not be transparent enough for the use for this type of use, but that's still, I would say, hotly debated item in the industry, and many folks are leveraging those methods if they're using more black box machine learning solutions. We don't have that problem, because the underlying nature of our models is they're interpretable, meaning they're visible or transparent, from the building blocks up, as opposed to layering a model on top of a model to understand how the model's working.
Right. And then you've got, you got the CFPB who've made it pretty clear that they don't want to see any bias in lending models. So,
Yep.
I imagine almost, if not all, lenders would be pretty aware of this today. And is the bias piece something that is top of mind for lenders today? Or how do you, when you're having conversation, is this sort of the feature that they're most interested in, or what's it like?
It's an interesting market environment. I would say top of mind for most banks is grow deposits, and then grow deposits, and then grow deposits. Mm-hmm. That being said, it is a huge focus. Banks right now, given the environment we're in, are slashing headcount, costs, et cetera, and looking for ways to automate processes, looking for scalability, looking for efficiencies via technology. AI and the subfield of machine learning has a ton of value to offer to drive those kinds of scalability and efficiency gains. But we find that many in the market are still fairly timid on using machine learning for these types of high value, high risk decisions with high levels of scrutiny. And, that's where we're really able to differentiate ourselves. That's why we've seen the growth that we've seen is because we can offer them the benefits of that technology without some of the drawbacks, without making them feel like they have to sit and blindly trust a score or a model they don't understand. They can very easily customize everything to their particular risk tolerance, their particular customer base. They see exactly what was learned from data, can change it, can override, can put additional information into the system that is outside the data to compensate for things like bias, to compensate for the things, things like the data is always backward looking. So that, I think, has really helped us in what is ultimately a tough environment.
So let's talk about the data itself, because I would love to kind of get a sense of the kind of data that is really becoming critical to some of the things we've talked about here, to identifying some of this bias, and maybe data that's less important.
A few things on the data side. Often we meet the customer where they are, and we have data partnerships, but Stratyfy itself is not a data provider.
Right.
So, we are not saying, hey, add this data element to your model and you're going to achieve analytics bliss. We are working with the data assets that they have, or data assets they acquire through one of our data partnerships, and making the best use of that, extracting maximum value from that. We still find that the majority of lenders, especially as you move into the community bank space, are still using traditional credit data. What they're looking for is a better way to extract value out of that data to achieve greater performance, greater accuracy, but without sacrificing visibility, transparency, control. There's a lot of talk about additional data elements, and many lenders, either fintech or larger lenders, are using other data elements to help, especially compensate for thin or no file applicants. From our work, it shows tremendous promise in these areas. I'm a big believer in rental payment data, for example, and in particular, the ability for that data to really help on the fairness side, drive down bias and help boost up some of those thinner file applicants. We've all seen, and I know you've read the studies, from FinRegLab and others. Who we also partnered with FinRegLab on a very interesting study on machine learning and underwriting, but cash flow based underwriting also extraordinarily promising. And again, we see different lenders at different points in their adoption curve on those alternative data. It's always interesting to me, though, because many lenders still, when you talk about alternative data or data outside of a credit report, think that you're talking about scraping someone's social media profile.
Right.
Right. And I often joke, like, in our space, alternative data is not that alterna, right?
Right.
So, sometimes you have to kind of talk people down as you're starting to broach that conversation. But in every one of those discussions, as I'm sure you can imagine, especially in the market environment, key question for that lender to answer is, what is the additional uplift that data element gives? Does it justify the cost I have to, or the friction I have to introduce to get it? And we often see folks using our products to help do that test, if you will, as well, to explore the value of that additional data element. The other thing I'll mention here, Peter, is that we have seen that you don't need thousands of attributes to make good decisions in credit, and that oftentimes there is almost like a point of saturation where, yes, perhaps you're adding marginal incremental value, but it doesn't necessarily justify the increased model complexity or the cost of that data. So we are not in the, like some of the others in our space, we look at thousands of attributes to make a decision with any of our customers right now.
So then when you sign up a new customer, a new lender, what is involved in the process of implementing Stratyfy? How long does it take? Take us through a typical journey there.
So initial engagements typically begin with a pilot agreement that runs for between 1 and 3 months. In that pilot agreement, we exchange data. That is the lender's data that is exchanged with us. It's all anonymized, so they don't have to share any PII with us or anything like that, which is quite helpful. And then we have conversations about if they want to explore other data assets. Again, usually in pilot, that's not something that folks are doing. And then we work with them to build an initial set of challenger models and challenger strategies. So models producing a score, strategy producing a decision, right? Work with them to produce a set of challenger models and strategies within our software that they can then evaluate. Then for ongoing execution, we're often integrating with an LOS for ongoing execution just via API, and that's all controlled by our products so that you can easily, with the proper controls, promote a new strategy to the one deployed for an API without having to change the integration. And then we see usually lenders will roll that in. So no lender's gonna, after a pilot, as we move forward into a long-term engagement, on day one, flip everything over to the new challenger model. So usually that gets rolled in over time, starting at a certain percentage and then kind of rolling that in.
Okay, so then how have your models that you've developed, your AI models, how have they improved over time?
So great question. And it gets me to another point of differentiation. We do not take our customers' data and then create a shared repository for all of that data that is then leveraged by every other customer. So our customers' data remains their data, which we see is really important to them. That said, with the way that our family of algorithms work, you could think of it as features or insights that are being extracted out of the data that is ours. And that is then used to enhance or improve, creating, if you will, the network effect for our company of, with every new customer we get, it adds value to everybody. So that's how we do it. We purposely, though, are not creating that, big data repository that everybody is drawing from.
Okay, so we're coming up on a year since Chat GPT was released and everyone started talking about AI. I mean, it's just amazing. You look through any newspaper today and there is AI. There's AI articles every single day. Everyone's talking about it. Has that changed your approach? Has it made it easier to kind of, or more difficult to kind of explain what you're doing?
Fantastic question. The answer is it has increased the conversations around the topic, and I think created almost two camps within financial services. And you could slightly correlate these camps to the asset sizes of the institutions they work with, but it wouldn't be perfect. And the one camp sees the promise, sees the value, sees the risks, of which there are many, sees the risks as well, but wants to figure out, and in many cases needs to figure out, a number of institutions that we work with, have a indirect mandate from their board to figure out a way to leverage this technology. So they have a real desire to figure out how to make it work for them with a healthy dose of fear. The other camp is just been too inundated, sees the word AI and immediately turns off. And, as I've been active on the conference circuit, as many others have for the past 2 months, and it has been very interesting to me to see people are not in between, or I have found very few in between. They fall in one of those two camps. I believe very strongly in the power that AI technology, broadly speaking, has to bring to the finance industry. If understand that with great power comes great responsibility, and these tools can be used to make things a lot better, especially in the issues of fairness. They could also be used to ingrain bias and scale bias exponentially into decisions going forward. And we're at, I think, an inflection or decision point where, I really hope it goes the former way, but if we don't have the right controls in place, controls that don't stifle innovation, but controls, we could have a situation where all of the biases of the past become encoded in the decisions of the future.
Right. So I want to switch gears a little bit and talk about raising money, because when we last chatted, I think you just closed your funding round. I don't even know if it was public yet, but you just closed it. Congratulations. It's not easy to close a funding round in 2023. So tell us a little bit about that process, who your investors and how that process went.
Well, it was a very challenging fundraising environment. There's no question about that. But we are very fortunate to have investors that both share our mission and values, but also see the tremendous upside for Stratyfy. We benefited strongly from having relationships over the long term, right? We have been around for a while, and we have been nurturing relationships with investors for a while. And that then meant that when we were going out to fundraise, we were actually, as shocking as it seems, given the funding environment, doing it opportunistically. We were raising at that time, not because we were running out of money, but because we had customers that we had either signed or were about to sign, and we needed to make sure that we could scale the team to meet the engagements that we had landed. So also being in that position put us in a greater, of course, position of strength to fundraise, but we wouldn't have been able to do it without those long-term relationships and without investors that really care about driving a fairer financial system and believe that Stratyfy is a key component to making that happen.
Okay, so then looking at your business today, what's your biggest challenge to try and grow Stratyfy?
One thing that is a challenge right now, and it's always challenging, selling into banks. Not an easy thing to do.
Right.
Not an easy thing to do. Sales cycles are long. Contracts are lumpy. We went into this, eyes open. It's not as if this was a surprise to us. We knew that was a challenging path that we were going down. But that's hard right now. That's hard right now in the market environment that we're in right now. And a lot of lenders are cutting back on risk, closing down products, And they, in many cases, are doing it with very blunt instruments, raising a FICO cutoff, completely closing down a certain offering, or completely selling off that offering to the secondary market, right? We see that as an initial reaction that will pass and also create tremendous opportunity, especially for community banks and regional banks that for so long have been squeezed by fintech lenders on one side and large banks on the other. So we believe it'll create a really meaningful opportunity. But right now that is a challenge. What I am really focused on in addressing that challenge is, a classic control the controllables. We have an unbelievable customer base today. Continuing to deliver to them in the highest quality way possible will give us new opportunities to expand with that existing customer base. And then I'm really focused on our team. We have built an absolutely unbelievable team. I'm very proud of the fact that is, a female-led team as well, which is a massive differentiator, if you will, in the market environment that we're in. I'm very proud of that. But, beyond any one thing that could classify any of our employees, I'm really proud of how committed they are to our mission, how passionate they are about the change that we're looking to drive, and how hard they are working to deliver on that. So, I'm really focused on growing that amazing team that we have to continue to meet the new market demand that we will eventually face, and weathering whatever challenges we have on selling into banks in the short term.
Okay, so let's end with a forward-looking question, and want to kind of get your sense of where we are today. I mean, AI continues to improve. How is this going to develop when it comes to credit and risk decisions for lenders? What's this going to look like in 5 years' time?
Yeah, so I believe very strongly that we will have a lot more automated decision making in lending. It's not to say that certain decisions won't still require manual review or won't still require a second set of eyes, but automated decisioning needs to proliferate further than it already has. And that's going to happen across different product lines. But what I think is really important, and this goes to the future of AI and credit and in other places, is that the types of systems that are going to win, that are going to provide the most value to customers, are systems that allow for input from ultimately multiple sources. So that could be data as one source, but also humans who machine learning is really good at eating data and finding insight. Humans are really great at applying context to that data, information that is outside of the data elements. So I believe the AI of the future, especially for regulated use cases, but I think for other use cases as well, as the public awareness of AI system grows, as we get new regulation likely coming over and kind of following a lot of the regulation that we've seen in Europe, and we've already seen the initial stride with that with 1033, there's going to be a real focus on how do I understand what is happening, not just from data, but also from people, combine those two into one automated system and ensure that I can tell the FI or the other type of business can tell their customer on the other side what the heck happened. How was this decision made? What information was used? How can I help you get to a different decision, which I continue to believe is a huge opportunity for a case where you have a negative outcome? How do you build a relationship with that customer to help them get to a positive outcome? It's going to be AI systems that can do that are going to actually deliver on all of the promise and all of the value that we hear about in all of the newspapers.
Okay, then we'll have to leave it there, Laura. Thank you so much for coming on the show today. Best of luck to you.
Thank you so much, Peter.
Well, I hope you enjoyed the show. Thank you so much for listening. Please go ahead and give the show a review on the podcast platform of your choice and go tell your friends and colleagues about it. Anyway, on that note, I will sign off. I very much appreciate you listening, and I'll catch you next time. Bye.